thing. I'm recording it. Okay. Okay. Gentlemen, we are starting the class. We welcome Mr. Saurav Agarwal, Scale 4 DO Jodhpur RO. We hope that you will find the session very useful. Kindly mute your mics so that the faculty will not be disturbed. Any questions? If we can save it for the last, and then we can get it clarified by our faculty. Saurabh, over to you, Saurabh. You can take on. Okay.
Thank you, sir. Thank you, sir. Am I audible, sir?
You are audible. You are audible.
Okay. Thank you, sir. Thank you very much. Good afternoon, friends. My name is Saurav Agarwal, and now Sir Ramesh sir has given me opportunity to take this class of finance and accounts. So, shall we start? Just before starting, I just want to ask.
Yes, Saurabh. Go ahead. Go ahead.
Okay. So, friends, in this class, this is normally I have not seen earlier any at any platform or association taking the class of finance and accounts. This is the first time because I'm also taking classes as a learner also when I am writing exam. But first time I have seen a class of accounts, so it's a very good initiative by UIO. So in this class, what our team has prepared, this PPT covers basically the fundamentals of from the exam point of view. See, the accounts is very vast subject. If you see the Insurance Institute's book of accounts also, that is very lengthy book. So accounts is very lengthy, but the paper is very easy. If you understand the accounts, you will find in exam the account you will find accounts the most easiest paper out of four or five, whatever you select. So in this PPT, our team has briefed the main basics of the accounts. So we will start one by one. First, this is the a common structure of questions and marking. Out of 30 marks, 25 is from accounts and 5 from IT. Mainly in IT, it is as Excel and Word, and maybe sometime the little bit of programming sort of thing. But that is very, very easy. And mostly out of accounts parameters, 8 marks are from investment, 7 are from preparation of final accounts. Accounting standards 4 marks, accounting ratio 2 marks, depreciation 2 marks, and income tax, maybe nowadays sometimes GST is also there. Taxation and other abbreviation maybe 1 or 2 marks. It's just a common understanding. There is no formula. There's no fixed formula. It will be like this only. But over the last so many years, so many attempts, this is the common understanding. Now coming to investment. So we'll first start investment. Investment, we can divide it in 2-3 parts. Mainly the investment portion is the regulations. Main thing in this regulation, how from the according to regulation, how we are covering our investments, we are making investment solvency. According to solvency margin regulation, also we have to adjust our investment, NPA, many things are there. All goes as per regulation. So we'll start from there. Investment regulation is mainly governed by these 3 regulations. In Insurance Regulatory and Development Authority, Investment Regulation 2000, Insurance Regulatory and Development Authority of India, Investment Regulation 2016, and Investment Master Circular 2020. So I'll request all the participants that this PPT definitely we are going to share, and this will have a brief of that. And brief is enough, but you just go through once all these regulations also. And summarize of that you will find in this PPT. This PPT is prepared by our team and is excellent PPT. You will find it everything here, which is we'll say fundamental. So we go through the regulations also and this PPT also. So we'll go through some definitions first. So first is investment assets. Investment assets means shareholders fund representing solvency margin and policyholders fund at their carrying value. Investment assets means in a common language, the assets which is available for investment. Assets which are available for our funds which are available for investment means solvency shareholders fund. There are two types of funds in any insurance company: policyholder funds and shareholders funds. Policyholder funds means your outstanding claim which is payable to policyholder in the future. As on, if you take the example of 31st March 2024, as on 31st March 2024, in the balance sheet of year ending 2024, the amount payable to policyholder, the amount which represents to policyholder today or tomorrow, it has to go to policyholder. That represents the policyholder funds, means outstanding claim which we are going to pay in future to policyholders. Premium deficiency reserve we'll discuss in next step, and our unexpired risk reserve. For unexpired risk reserve, you all know. Again, I'll tell you the portion of premium which is the part of next year, where the risk will end, has started in this year, but it will end in the next year. So the premium which we have booked in this year, but some portion of that will go to the next year. So that definitely that pertains to policyholders. So these three things mainly pertains to policyholders fund, and balance is shareholders fund. So investment assets is assets available for investment, means shareholders funds representing solvency margin and policyholder funds at their carrying value. Money market instrument means short-term investment with maturity not more than 1 year. So there are in brief and wider language, there are two types of investment: long-term investment, short-term investment. Short-term investment means which are going to mature within a period of 365 days. That is short-term, and balance are long-term investment. Money market investment is a short-term investment, which is, I will say, readily convertible in money, in cash, as a liquid assets. For example, certificate of deposits, commercial paper, reverse repo, sometimes we have to deal, treasury bills, call, notice, term money, CBLO. Now comes to shareholders fund. Shareholders fund means the money which belongs to the owners of the company. In a common language, money which belongs to the owners of the company is a shareholders fund. Shareholders means they are stakeholders of the company. So shareholders fund, as a definition, comprises of share capital plus reserve and surplus, except a revaluation reserve and fair value reserve. Pre-reserves. This revaluation reserve is a notional reserve. That's why it is not forming part of shareholders fund. And fair value change account, definitely fair value. What is fair value change account? Fair value change account is the difference of your purchase value of investment and current market value of the investment. And definitely, it's a notional amount. There is no it is not something earned as of now. This is only a difference between the amount on which we have purchased our equity share or investment, whatever it is. Today, what is the current market value of the investment? So it is unrealized. So these two things, revaluation reserve and fair value change account, will not form part of shareholders fund, because these two are only notional funds. Balance things, balance reserves and share capital, definitely as at balance sheet date, is a shareholders fund. Now, the shareholders fund represented by investment of funds held in business beyond solvency margin. Policyholders fund, already we discussed, again we'll discuss here. Policyholders fund means estimated liability outstanding claim, including IBNR, and expired risk reserve, catastrophe reserve, premium deficiency, other liability, net of other assets. So the constituents of this policyholders fund is estimated liability, means outstanding claims, definitely including IBNR, unexpired risk reserve, and premium deficiency reserve, catastrophe reserve if something has been prepared for, and other liability which does not pertain to policy shareholder. Liability which is going to pay to policyholder in the future. Now coming to next definition, a very important definition, and means it's this thing is something now can be asked in the exam very easily. Approved investment. In the next slide we'll see. Just I will go to the next slide, then come back to the previous slide. These are the regulations. How much investment can be made in which type of securities. So there are four types of central government, state government, approved other investments. So approved investments, there is a definition of approved investment. What are covered in the approved investment? So investment means just out of this book. Investment means if you are going to invest, either we can invest in equity, we can invest in preference share, we can invest in debentures, we can invest in loans, we can invest in immovable property, this sort of thing. So these investment, there are some regulations. If you suppose you take the first thing, debenture, if you are investing, debenture secured by first charge, which has paid interest on full. If you go further in this, first charge means suppose we are investing in a company ABC Limited. If we are going to invest debentures for ABC Limited, debenture should have a first charge on the assets. In the event of liquidation of ABC Limited, the first money will be used to pay the debentures, and which has paid interest in full in the previous quarters, previous months. So that is an approved investment, where the debentures secured by floating charge all on a lesser by the company which has paid dividends on equity shares. If debentures are secured by floating charge means it will come in proportionate in debentures, other liabilities. In that case, if that company should have paid dividend on its equity shares. Preference share on the company which has paid dividend on equity share for at least 2 consecutive years immediately preceding. In case we are investing in preference share, equity share of a listed company, preference share of any company, equity share of a listed company on which not less than 10% dividend has been paid for at least 2 consecutive previous years. In case we are investing in equity shares, what has to be taken care that a company should have paid at least 10% dividend in the previous two years. Continuous in the previous 2 continuous years. Immovable property is situated in India, provided the property is free from all encumbrance. Loans on policies of life insurance within their surrender value issued by them. Fixed deposit with banks. Fixed deposit is always approved and secured investment. Now coming to the regulation, the limits of investment in security wise. There are various limits. We will discuss one by one. First limit is security wise. First, central government securities not less than 20%. Before 2016, there was earlier regulation. There are many restrictions, and the most of the money has to be invested in the government bonds, government securities only. After 2016 regulation, this has been liberalized. So in liberalization, you see the earlier it was not less than 20%. It was for the equity shares that you can maximum this thing you can do. Now the limit is central government securities not less than 20%, means minimum 20% should be there in central government securities. Central government, state government, or other approved securities should not be less than 30%. Means in total, central government plus state government plus other approved should be minimum 30%. So now balance 70%. 70% goes to the approved investment. So approved investment not exceeding 70%. Other investment that is not more than 15% out of the above three. Housing and loans to state government for housing and fire fighting equipments by way of subscription or purchase of investments in housing, investment in infrastructure. Total investment in housing and infrastructure, investment in categories 1, 2, 3, 4 above, taken together shall not be less than 15% of the investment assets. Means total investment in housing and infrastructure sector, whether it is central government, state government, should not be less than 15% of the total investment assets. Investment made under category 1 or 2 means central government, state government. Above may be considered investment in housing or infrastructure as the case may be, provided the respective government issues such as security specifically to meet the needs of any sector specified as infrastructure facility. Then, now these were the limits, the percentage limits. Now coming to the further regulations. If any investment are required to be rated as per SEBI regulation, because all securities are governed by SEBI. So any investment is regulated by SEBI and it has to be rated as per SEBI regulation, then we can only invest in the security if it is rated. So I'll just read this. All investments in assets or instruments which are capable of being rated as per market practice shall be made on the basis of credit rating of such assets or instruments. No approved investment shall be made in instruments if such investments are capable of being rated but not rated. Understood this point, no? If the investment is to be rated as per SEBI guidelines, then we can only make investment which is properly rated. Rating should be done by the credit rating agency registered under SEBI Credit Rating Agency Regulation 1999. Corporate bond or debentures rated not less than AA or its equivalent and A1 or equivalent rating of short-term bonds. Corporate bonds के लिए for corporate bonds and debentures it is AA, and for short-term bonds, debenture certificate to deposits commercial paper by credit rating agency means all money market instruments sort of thing. A1, they should be rating A1, registered under SEBI, same regulation, would be considered as approved investments. Investments in equity shares listed on recognized stock exchange should be made in actively traded and liquid investments. There are two types of equity shares: actively traded, which are traded on Nifty and Sensex, and there are one thinly traded. So equity shares other than those defined as a thinly traded as per SEBI regulation guidelines governing mutual funds issued by SEBI from time to time. So in short, that investments cannot be made in thinly traded securities. It can be made only in actively traded investment. It can be made in mutual funds also, but should be actively traded. So if you are making in mutual funds, the backed securities against which mutual fund is issued should be actively traded. Investments in debt instruments rated AA minus or below for long term and below A1 or equivalent for short term debt instruments shall form part of other investments. I'll come back to this. There are the approved investments not exceeding 70%, other investments not more than 15%. So what comes under other investment which are not covered in the approved investments comes under other investments. So here we have seen that for debentures there should be rating of AA, and for short-term debentures, money market instruments, there should be rating of A1. So here, if the debt instrument rated A minus means it is below A, and below A1 for short-term debt instrument shall form part of other investments. Suppose we have invested in something which is rated A today, and later when becomes A minus by some exigency in that company, so that will cover under other investments in the next year. Not more than 8% of the investment in debt instruments, including central government securities, state government securities, or other approved securities, in case of general insurer, shall have a rating of A or below or equivalent rating for long term. And not less than 65% of investment debt instrument, including central government, state government, other approved securities, in case of general insurer, shall be a sovereign debt, shall be in sovereign debt AAA or equivalent rating for long term, and sovereign debt A1 plus or equivalent for short-term investments. So out of the total approved investment, 65% of the long term should be AAA rating, and for short term should be A1 plus rating. These are the exposure norms. Exposure norm means how much we can invest in a particular sector, particular company, in this thing. So investment in equity, preference share, convertible debentures. For each investee company, there is a limit of 10% of outstanding equity shares of the other company. Limit for entire group, same 50, sorry, for individual companies is 10%. For entire group of the investee company, 15%. For industry sector, limit is also 15%. Investment in debt, same things, same limit is there. Investment, debt, loans, and other permitted investment, 10% of paid up share capital, free reserves, and debentures. The only difference is in case of equity and preference share, it will be 10% of outstanding equity, but in case of debt, it is for the net worth, paid up share plus free reserves. Again, revaluation reserve is a not free reserve, so it will not be considered. For entire group of investing company, not more than 15%. And investment by insurer in any industrial sector should not exceed 15%. So 15% is a overall limit for the investing company, for group of investing company for the industrial sector. Another thing, this limit is for on the basis of amount of investment. If the investment value is 2,50,000 crore or more, then equity limit for equity is 15% of outstanding equity share, and debt is also 15% of net worth, paid up share capital plus free reserve and debenture and bonds. If investment assets is 50,000 crore but less than 2,50,000 crore, then 12% outstanding equity share and 10% of this paid up share capital plus free reserve. Less than 50,000 crore, then 10% of outstanding equity share and 10% of paid up share capital free reserve. So if your investment value is more, then no, there's a leverage of taking more risk. If the investment value is less, then leverage is less, taking risk in the particular sector, particular company. Industry sector norms shall not be applied for investment made in infrastructure facility sector. This is important point. All investment made in infrastructure investing company shall be subject to promoter group exposure norms. Exposure to public limited infrastructure investing company will be 20% of outstanding equity share in case of equity. The 20% mentioned above can be further increased by additional 5%, which will be 25% in case of debt instrument. Now, investment in secured assets, mortgage-backed assets or asset-backed securities, security receipts both under approved and other investment category shall not exceed 5%. So that limit is for approved and other investments. I'll just come again. This limit is for the category of investment. Then these are the in this category, these are the further regulation for the rating. On the basis of rating, what should be the percentage of your portfolio? This limit is for exposure norms in a particular investing company, so that company should not go for a bad loss in case of a particular downfall of a particular company, downfall of a particular sector. This limit is for the amount on the basis of investment assets for a particular company. Now here comes, in this portfolio, what are the mix we can have, what are the mix of the investments we can have. So first thing, investment securities both under approved and other investment categories shall not exceed 5% of the investment assets in case of general insurance companies. Approved investment in money-backed securities and asset-backed securities with underlying housing or infrastructure assets shall not exceed 5% of investment assets in case of general insurance companies. So you just need to remember these limits. These limits can be asked 5%. What is the limit for money-backed security, asset-backed security, housing sector, infrastructure sector assets? So these limits you have to remember, nothing else. The exposure limit for financial and insurance activity shall stand at 25% of investment assets for all insurers. Investment in FD shall not exceed 15% of investment assets in case of general insurer. The investing company debt exposure in housing finance companies rated not less than AA plus shall be up to 20% of paid up share capital, free reserve, and debentures, bonds, or amount under regulation 9B1, whichever is lower. 9B1 means the first regulation, which we just see before. The 20% limit mentioned herein can be further increased by 5% in case of the prior approval of board. All exposure norms applicable to promoter group shall be applicable to all investment made in the housing finance company. Means the exposure norms will be same. In housing finance company, if we are going to make investment in debt, debentures, then it should not be rated less than AA plus. So these were the investments, exposures norms and regulations. Now these are the returns to be submitted. This is also part of the investment regulation. There are various returns. I am not going to read it. There are quarterly returns. All are quarterly returns. I'll tell you one thing, in investments, all returns are quarterly, first of all. And there are 10 types of returns, Form 1 to Form 7, Form 1, 2, 3A, 3B, 4, Part A, Part B, 4A, Form 5, 6, 7. So this just you read out this. all have to be mostly have to be verified by principal officer, chief investment officer. And time limit for all the returns are 30 days from the end of the quarter. Now there are further provisions. Provisions on investment management. Every company has to make an investment committee. So now who will be the part of investment committee? Every insurer shall constitute an investment committee which shall consist a minimum of 2 non-executive director of the insurer, chief executive officer, chief of finance, chief risk officer, chief of investment division, and appointed actuary. I'll just read again. 2 non-executive director, chief executive officer, chief of finance, chief risk officer, chief investment division, and appointed actuary. The board of the insurer shall ensure that chief of the finance and chief of investment and chief risk officer shall fulfill the minimum qualification requirement specified in the regulation issued by authority. The decision taken by the investment committee shall be recorded and be open to inspection by the officers of the authority. Authority means IRDA. Investment policy. Every insurer shall draw up an investment policy and place the same before its board of directors for its approval. So as per the regulation, every every insurer has to, insurer is also investor only, has to draw up a insurer investment policy, and policy should be as per the regulation which we have seen in the previous slides. So there are regulations that there should approved insurance should not exceed 70%. So accordingly, every insurer has to draw up a investment policy and it should be placed before the board of directors for its approval. Every insurer shall have a model code of conduct to prevent insider personal trading of officer involved in the various level of investment operations in compliance with SEBI Prohibition of Insider Trading Regulation 1992 as amended from time to time and place the same before its board of director for its approval. So to prevent the insider trading and personal trading of the officers involved in investment department, every insurer has to devise a code of conduct. These are some sections which deal with the investment. Just for once you should know, these questions may ask which this section pertains to what. Out of this section, which pertains to investment. So section 27B deals with investment by non-life insurers. 27C pertains to investment of funds in India and profits from funds outside India. Just I'll tell you here that only shareholders' funds can be invested outside India. Policyholders' funds cannot be invested outside India. So 27D gives the IRDA this power to make regulation in this regard. So I'll just read it out. 27C and 27D were inserted by IRDA Act 1999. While the former prohibits an insurer from investing their funds outside India, the latter gives the regulation making power to IRDA. 1 minute, please. Yeah, sorry for difference. See 27C, investment made outside India can be made out of shareholders' fund only in excess of solvency margin. Means, in short, in other words, policyholders' funds cannot be consumed for investing assets outside India. Only shareholders' funds can be used because the main motive of the IRDA to make so many regulations is to prevent policyholders' funds. So that's why they have only permitted the shareholders' funds, investment out of shareholders' funds can be made outside India. 27D, manner and condition of investment, which is IRDA has to issue. Section 28, statement of investments of assets returns, which we have seen here. These are the credit rating agency. These may be important because many times they are asking which are out of these four, which one is the credit rating agency. Sometimes they are the full form of credit rating agency. Also, CRISIL. What is CRISIL? Credit Rating Information Service of India Limited. What is ICRA? Sometimes they will ask what is ICRA, whether it's a credit agency or any mutual fund or any investment assets, whatever thing they can ask. ICRA, Investment Information and Credit Rating Agencies of India. So this is the one agency in India. All are means this ICRA is made recently. CARE, Credit Analysis and Research Limited, and Fitch. Foreign rating agencies, Standard and Poor's, Moody's Investors Service. Now, these were the up to investments. So we have covered investment. Now we'll come to financial statements. Before starting the financial statements, I'll suggest everyone that if you're writing accounts paper, my suggestion is that you read our annual report. United India's annual report, you read it fully, at least from the page where the CAG audit report starts. From that page, you read it once, your 60-70% concept will be, after this PPT, if you read the annual report, no, your concept will be clear. You need not to know go through this PPT again and again. Just once go through this and then go through the annual report. Your all concepts will be clear, because whatever is there in the regulation which we are going to discuss now, everything we have followed in our final accounts and which is reflected in the annual report. So always go through the annual report. That will clear all your doubts and it will give you a brief also, very helpful for the exam. So in preparation of financial statements, following acts to be followed: Insurance Act, Companies Insurance Act 1938, Companies Act 2030, IRDA regulation, which one the latest regulation is preparation of financial statements and auditors report of insurance companies, regulation 2002. So this IRDA regulation, it has three schedules. Schedule A is for life insurance, Schedule B is for general insurance, and Schedule C is for the auditor's report. So in Schedule B, how it is divided? Part 1 is accounting principles for preparation of financial statements. What is accounting principles? The common accounting principles, whether we have to, how URR will be prepared, calculated. What are the basic principles to finalize the accounts? There is one thing, making accounting entry, finalizing accounts, then making revenue account, profit and loss account. That is separate thing. That is preparation of final accounts. Disclosure is separate part, and compliance is a fourth part. So the part 1 says about the accounting principle for preparation of financial statements. Part 2 is for disclosure forming part of financial statements. Part 3 is for general instruction for preparation of financial statements. And part 4 is contents of management report. After we'll discuss this also. There is management report also, and there is a fixed format. These are the things you have to show in the management report. Part 5 is preparation of financial statements. So what are the statements are prepared? Revenue accounts, P&L account, balance sheet, cash flow statement. These are the schedules forming part of financial statement. The first 4 schedules are revenue schedules. Schedule 1 is for premium, Schedule 2 is for claims, Schedule 3 is for commission, and Schedule 4 is for management expense, operating expense related to insurance business. So out of these 4 schedules, we'll calculate our underwriting profit. Then the balance 11 schedules pertains to balance sheet. So Schedule 5 and Schedule 6 is for shareholders. Schedule 5 is for share capital. Schedule 6 is for reserve and surplus. Schedule 7 is for borrowings. If we have taken any borrowing, if we have taken any loan, so that will appear in Schedule 7. But borrowing is not allowed for insurance companies, so this is always new. Then Schedule 8 is for investment. Schedule 9 is for loans. Loans means where we have made investment in the loans. We have given loans to state governments, housing board, all those things. So these two, Schedule 9 and Schedule 8 and Schedule 9 is for investment. Schedule 10 is for fixed assets. Schedule 11 is for cash and bank balance. 12 is for advance and other assets. 13, 14, 15 is for liabilities. 13 for current liabilities, 14 for provisions, 15 for miscellaneous expenditure, not written off. So further, if we bifurcate this, First 4 schedule is for revenue. 5, 6, and 7 is for liabilities, shareholders fund. 8 and 9 for assets. 10 is for assets. 11, 12 is for liquid assets. And 13, 14 is for liabilities. Now, Schedule C, as we discuss here now, Schedule C is for auditor's report. So, a regulation what says that what auditor has to certify. Auditor has to certify whether balance sheet gives a true and fair view of the insurer's affairs at the end of the financial year, where the revenue account gives a true and fair view of the surplus of the deficit of the financial year. Profit and loss account gives a true and fair view of the profit or loss of the firm on a financial year. Whether receipt and payment account gives a true and fair view of the receipts and payments for the financial year period. Investment has been valued in accordance with the provisions of the Act and this regulation. The accounting policies selected by insurer are appropriate and in compliance with the applicable accounting standards and with the accounting principle as prescribed in these regulations or any order or direction issued by authority in this behalf. So if you come to this trail one by one, it says balance sheet gives a true and fair view of the insurer's affairs as the balance sheet end of the financial year, because the balance sheet shows the final balances, the balance of assets and liabilities. From revenue accounts, we generate the revenue profit or loss. From profit and loss account, we get the actual profit or loss after considering investment income, other income, all other things which is not related to insurance. Receipt and payment is like a cash flow. So these are 4 things. Now, auditor's report, what he has to comment is governed by the ID regulation. Appointment of statutory auditor is governed by Companies Act 2013, Section 6192. This is important. That's why we have covered in this PPT. Sections may be asked. Section 6192 of the Companies Act. CAG audit of the government companies is carried out as per provision Section 619 of the Companies Act 2013. There are 4 types of audit: statutory audit, CAG audit, internal audit, concurrent audit. This concurrent audit, there is one system audit also. Concurrent audit is done at investment department as per regulation. System audit is also done in the investment department. Other than this, as per regulation, there are only 4 types of audits. Other than this, there are migration audit, system audit. There is a different part. If that is occasionally, if suppose we have migrated the software, then there is a migration audit. All those things happens. But mainly there are 4 type of audit: statutory audit, which is done by the statutory auditors, chartered accountants appointed by CAG. CAG audit, which is done by CAG itself after the statutory audit is completed. So this CAG audit is the audit of the work done by statutory auditors. The internal audit is our own. Since we have our own internal department, so internal audit. And concurrent audit is also as per IRDA regulation done by chartered accountant. This we have to appoint. Every balance sheet, revenue account, policyholders accounts, means revenue account is a policyholders account, and this thing P&L account is shareholders account. So every balance sheet, revenue account, receipt and payment account. So already I told you receipt and payment is cash flow and profit and loss account. Of an insurer shall be in conformity with the accounting standards issued by ICI to the extent applicable to insurers carrying on life insurance business, carrying on life and general insurance business. Sorry, rectify this. Except that, so what is the basic meaning before this? That there are 34 accounting standards issued by Institute of Chartered Accountants of India. We have to follow all 34 standards. Whatever the standards applicable to us, what are the transactions we are doing, all 34 we have to follow. These 3 accounting standards, with some exceptions, we have to follow. Like AS3 is for cash flow statement. In as per accounting standard, there are 2 types of cash flow. 2 types cash flow can be prepared: direct method, indirect method. But as per our regulation, we have to prepare only under direct method. Then AS17 segment reporting. Segment reporting as per accounting standard is applicable only for the listed companies. But in our case, segment reporting has to be done irrespective of whether securities of the insurer are traded publicly or not. Segment reporting, as per IRDA regulation, what is the regulation? That there are some segments, when you read the annual report, you will find out minimum there are some like fire, marine cargo, marine hull, motor OD, motor TP, aviation, PA, this thing. Other things are there, health. We have to definitely show as a segment wise report for that. If any segment which comprise of 10% of the total premium of the insurer, then that also we has to be shown separately as a segment reporting, whether our shares are listed or not. So that's why this AS 17 is not applicable exactly what is means what is there in the accounting standard. AS 13 is not applicable because AS 13 is for accounting of investments and valuation of investment. So that is governed by the as per IRDA investment regulation. Out of the 34 accounting standards, we mainly use accounting standard which can be asked. I will request everyone to know just to remember the number and name of the accounting standard. Number, what is AS1, what is AS2, what is AS3, and name. So that can be asked. So like AS1 is for disclosure of accounting policy. AS2 is valuation of inventories. Is not applicable to us. We do not use it. AS3 cash flow. AS6 depreciation. AS10 fixed assets. AS15 accounting of retirement benefits. AS17 segmental reporting. AS18 related party disclosure. AS26 intangible assets. AS29 provision for contingent liabilities. Other accounting standard also, just go through, just remember the name and the number. Now coming to the ratios. First is gross direct premium growth rate. The name suggests itself, the difference, the growth rate of gross direct premium. So gross direct premium of current year minus previous year, growth of direct premium divided by the growth direct premium of the last year, to be shown in the percentage terms. Gross direct premium to net worth. So gross direct premium divided by net worth. Net worth means share capital and reserve and surplus. And growth rate of net worth. So the growth of net worth divided by the net worth of the previous year. This should be shown in the percentage. Net retention ratio. Net retention ratio, how it will be calculated? Net premium. Net retention means what is the direct premium plus what is the RI acceptance. The inward total, out of the total inward, suppose our direct premium is 100 rupees and we have also accepted reinsurance of 20 rupees. So our total inward premium is 120. Out of that, how much we have ceded? Suppose we have ceded 40 rupees. So 80 we have kept with us. We have no expose ourselves to the risk of 80 rupees. So that is net retention ratio. So net premium like 80 divided by 100 plus 20, 120, to be shown in percentage. Net commission ratio. Net commission ratio means net commission gross or direct commission plus RI accepted minus RI ceded divided by net premium. Then expense of management to GDPI. Now in the new recent regulation, means in the same 2002 only, when the master circular came, expense of wherever the terms expense of management comes in the ratio, it includes commission. Earlier it was not including. So expense of management ratio to GDPI means direct commission plus expense of management operating expense as per schedule 4 divided by GDPI, gross direct premium income. Net incurred claim to net earned premium means incurred claim plus RA adjustment plus minus RA adjustment divided by gross direct premium income plus minus RA adjustment plus minus URR. Means net incurred claim divided by net earned premium. How net incurred claim and net earned premium is calculated, that is shown in this paragraphs. Bracket, sorry. Combined ratio. Combined ratio is the combined ratio normally many times we use in our common language the what is our underwriting profit, what is our combined ratio. Same thing, what we use the same thing is their combined ratio means in claim plus commission plus expense of management divided by net return. Underwriting balance ratio. Underwriting balance means underwriting profit, operating profit. So what is the operating profit divided by net earned premium? That is underwriting balance. For each segment, suppose we take fire, marine, whatever, any segment, what is the operating profit for the segment divided by the premium? That is underwriting profit, underwriting balance ratio. Operating profit ratio means underwriting profit plus minus investment income adjustment is there divided by net premium. See, this is tricky. In underwriting balance ratio, there is a net earned premium, but operating profit ratio, there is a net premium. Liquid assets to liquid ratio. Liquid assets means the assets which can be immediately converted into cash. That is liquid assets. Same thing, liquid liabilities. So, but here the ratio is liquid assets to liability, not liquid assets to liquid liability. Liquid assets to liability. So, liquid asset divided by policyholders' liabilities. So, liquid assets is cash and bank balance, short-term investment and loans, which can be easily converted into cash, divided by policyholders' liabilities. Policyholder liability means we discussed earlier also outstanding claims, premium deficiency reserve, and unexpired risk reserve. Net earning ratio. Net earning ratio means what is the amount of profit earned to the net premium. So it means profit after tax divided by, suppose our net earned premium is, our net premium is 70,000, 20,000 crore. Our profit earned is 400 crore. So 400 divided by 20,000. That is our net earning ratio. Return to net worth is profit after tax divided by net worth. Net worth we have many times we have discussed. Net worth means share capital plus free reserves. Free reserve does not include notional reserves. See why I am telling you again and again this notional reserve, because this is very, very important. It's maybe tricky sometime. Notional reserve, revaluation reserve is a fair value, and fair value change account is a notional reserve which will not part of the shareholders fund. It means it will not part of the net worth. So wherever net worth comes, net worth means shareholders share capital plus free reserves. Free reserve does not include revaluation reserve and fair value change account. Solvency margin. Solvency margin is available solvency margin divided by required solvency margin. In short, we say ASM divided by RSM. ASM means available solvency margin. RSM means required solvency margin. Now, is for depreciation. Schedule 2 of the Companies Act 2013 has to be followed for depreciation purpose. I'll just tell you here that when this Companies Act 2013 came into force, it has completely changed the calculation and manner of depreciation. Earlier, in Companies Act 1956, Companies Act itself gives the rate for each category of the assets, for motor car, for furniture, for office equipment, for electronic equipments, for all those things, it was giving a rate that this rate you have to follow for WDV method. Now in 2013 Companies Act, the act does not specify the rate. It specifies the category of the assets. What are the assets will come to which category, and for each category it gives you useful life of the assets. Suppose for motor car, it is 5 years. We are also using 5 years. It gives a useful life of the assets. According to useful life and residual value, we have to calculate the rate. A rate, if we apply that rate as a WDV on each year on WDV, at the end of the useful life, it will rest you with the residual value. Suppose our motor car is for 1,000 rupees, taking a very small example, 1,000 rupees motor car, but just for example, motor car is for 1,000 rupees and residual value is 5%. 5% means 50 rupees. So means in 5 years we have to depreciate from 1000 to 50 rupees. 950 amount we have to depreciate. So the rate has to be calculated in this way. If you calculate a constant rate on WDV for 5 years, at the end of the 5 years, you should have in your books 50 rupees for a particular motor car. So that is the difference between old Companies Act and the new Companies Act. We'll just go through this. Key requirements of schedules 2 are given below. Mode of charging depreciation has to be disclosed, whether WDV or straight line method. Depreciation will now be charged depending on the useful life of the assets. The useful life to be taken is given in Schedule 2. The rate of computing depreciation has to be calculated using the useful life provided by the Companies Act 2013. Means the Act gives you useful life. It does not give you rate. It gives you useful life. On the basis of useful life, you have to calculate the rate. There is no requirement to charge 100% depreciation on assets whose actual cost does not exceed 5,000. That is okay. That's old scenario. Assets used for more than, suppose assets is purchased during the year, in between the years. So assets used for more than 6 months, 100% depreciation. Used for less than 6 months, 50% depreciation. So this in between this one thing came, no, there is no requirement to charge 100% depreciation on assets whose actual cost does not exceed 5,000. Earlier there was thing that if the asset value is less than 5,000, then you charge everything in the profit. Now that also, if you want, you can add in the assets and charge depreciation. So these are the rates what we are following for this thing. These are the rates we are following for depreciation. Office equipment, AC, generators, fans, general furniture, motor car, cycle, office building, residential building, computer, other IT equipment. So I use the example of motor car. The motor car, if you apply 25.89% WDV for 5 years on 1,000 rupees, starting with 1,000 rupees, at the end of 5 years, you will find 50 rupees only in the WDV. So that is the logic behind calculation of rates. So now preparation of final accounts is over up to here. Now we'll come to the TDS and GST part. TDS just, our team has just shown the TDS rates. You have to remember these rates. Any rate can be asked. Normally, in our case, mostly is asked 194A and 194D and 194J. For 194A, it is 10,000. Threshold limit is 5,000. For MACT case claims, interest on MACT claims, it is 50,000. 194C, it is for individual, it is 1%. For other than individual and HUF, it is 2%. They should always remember the threshold limit. That is very important. 30,000 per payment and 1 lakh per contractor per annum. If the single payment is more than 30,000, then TDS has to be deducted. So, if even if total payment in a year is 80,000, but if single bill is more than 30,000, then TDS has to be deducted. If single bill is less than 30,000 and in a year it is less than 1 lakh, then no need to deduct TDS. In a year it goes more than 1 lakh, then TDS has to be deducted. In case of transporter, if furnish the pan, it is nil. 194D, we all are well versed with this. It is 5% and 5% for individual and 10% for corporate. Commission and brokerage. Commission and brokerage other than insurance commission. It is 2%. It is recently amended, so just to be remembered, can be asked. 2%. For rent and land and building is 10%. For plant and machinery it is 2%. Threshold limit is same, 2,40,000 for both of that. 194J, now earlier it was straight 10%, but last 2 years it has been bifurcated towards technical fees for technical services is 2%, towards royalty it is 2%, and any other sum it is 10%. So our surveyors and advocates comes under third category. Payment of compensation of acquisition of certain immovable property, it is 10%. Compensation on payment of in case of compensation is 10%. In case of normal transfer of immovable property other than agricultural land, it is 1%. The amount is more than 50 lakh. Okay, the last year the new section introduced 194N. Sorry, last year where the cash withdrawal, there is a TDS charged by the bank in case of cash withdrawal exceed 1 crore. For e-commerce operators, for sale of goods or provision of service facilitated by it is 0.1%, more than amount more than 5 lakh. And this one is next one is very important. Many of us are missing out this 194Q, payments for purchase of goods from a single party under a single pen. If we purchase the goods for more than is 50 lakh during the year, there is a TDS provision of 0.1%. This mostly comes in case of electricity payments. In a state, normally a single electricity board is there, and we are purchasing electricity is a goods in the terms of GST, also in the terms of income tax also. So if your purchase of goods from single vendor, if you are purchasing more than 50 lakh, then there is a TDS provision of 0.1%. Payment to non-resident, simply it is 31.2%, but there are various provisions and various things. It's more thing. But if this starts 190, 195, we can easily write 31.2%. Earlier, education says and higher education says and surcharge is to be charged. Now there is no requirement other than salary. Section 194C also includes a contract for carriage of person or goods. Accordingly, the higher charges paid to cab operators exceeding 1 lakh per annum or 30,000 per payment will be subject to TDS. Here we have seen, here we have seen 194C, 30,000 per payment or 1 lakh per contract. So this includes payment to cab operators also if it is as per contract. They are regularly providing service to in the name of United India. In respect of all cases where PAN is not furnished, tax is deductible at the rate of 20%. Now we'll discuss this new section, section 206AB and section 206CCA of the Income Tax Act. As per section 206AB of the Act, if a person does not have a PAN, and in the case of individual has not filed his income tax return but has a credit of TDS, TCS of more than 50,000 in the last 2 years, will be subject to TDS, which shall be higher than the following: either twice of the rate stated in the applicable section, or twice of the existing rate, or at the rate 5%, whichever is higher. It means, I'll just again brief this. It means if a person does not have a PAN, okay, if he has a PAN and has not filed his income tax return from last 2 years, in case he has a TDS of more than 50,000 in the last 2 years, a person may have PAN but not filed return, no problem. But he has not filed return, but he has a TDS of more than 50,000 in the last 2 years. Then he will be treated as a specified person by the income tax. A specified person means a person under watch. So in that case, the income tax says, if you deal with a person who does not have PAN and has a TDS of 50,000, or he has a PAN or he has not filed return from last 2 years, where if he have TDS of more than 50,000, then he will be subject to TDS of higher TDS rate. Then he will be subject to the higher TDS rate. What is the higher TDS rate? A rate twice at twice the rate stated in the applicable section. Suppose we are doing for 194J, so section rate is 10%, it will be 20%. Another limit is at the twice the existing rate, means the 20% or 5%, whichever is higher. Suppose in under 194C, the rate is 1%, but twice of the rate is 2%, and it is 5%. So we'll charge 5%. In case of 194J, we'll charge 20%. So this section is not applicable for non-resident who does not have a permanent establishment in India. Now we'll come to GST. GST was introduced in July 2017, and from the very starting of the GST, there are two mechanisms. It was there in service tax also, two mechanisms. When for earlier Prime Minister Manmohan Singh ji, when he was Prime Minister, he brought the mechanism, reverse charge mechanism. So that was followed in the GST also. Forward charge mechanism and reverse charge mechanism. Just briefly, I'll tell you what is forward charge and reverse charge. Forward charge is something we are providing service, like we are providing insurance service. We are providing service, we are charging money from the other person, from our service receiver. We are charging 100 rupees for our insurance service and we are charging 18 rupees from it as a GST and we are paying to the government. This is a simple mechanism. This is called forward charge. We are at front side we are taking from the service receiver and paying to government. A simple mechanism, that is forward charge. Reverse charge is something that in case we are receiving services, we are not providing services, we are receiving services, even then we are paying 100 rupees to the vendor for receiving a service. On that 100, now vendor is free. We have paid 100 rupees to vendor, use his service, he can go home, he is free. We are now liable for 18 rupees GST or 20, whatever the rate. Suppose we take 18 rupees the fixed rate. We are liable for 18 rupees on that 100 rupees to be paid to government. Means our net cost comes to 118. But this 18 rupees can be used as an input if we have enough liability in the forward charge. Okay. So reverse charge is when we are using service, or on that service also we have to pay GST to the government. That 18 rupees will be our cost unless we have enough outward services where we are charging forward charge and we have to pay to government, so we can adjust against that. So forward, in our case, forward charge mechanism is followed in case of mainly premium, miscellaneous income, our check dishonor charges, our sale of scrap newspaper, wherever we are charging money from the other person for providing our service. Reverse charges for certain services, agency commission, our advocate, mainly sponsorship service. Many services are there, but main thing is the bulk of amount comes from the agency commission and advocate payments. Against the liability, whether it's a reverse charge mechanism liability or forward charge, we can use the input services which we are consuming or we are paying tax. Suppose brokerage, TPA, survey fees, our motor claims, motor OD claims, where we are paying amount including GST, and that we can use as a input from the our outward liability, whether it is a forward charge mechanism or reverse charge mechanism. Okay. GST rates. Insurance as of now it is 18%. Only for the commercial vehicles, basic TP premium is 12%. This is just to be remembered. So this is the last one. These are some of the abbreviations. SEBI, Security Exchange Board of India, NEFT. Normally use the word NEFT, RTGS. NEFT is National Electronic Fund Transfer. RTGS is real-time gross settlements. What is the difference between NEFT and RTGS? RTGS is real-time gross settlement. Now I am making payment. Immediately it will be processed by the what is that in between bank? No, what it says. It will be processed by the system immediately, and immediately it will go to the other bank. But there is a limit of 2 lakh. We have to do RTGS. It should be minimum 2 lakh rupees. NEFT is the National Electronic Fund Transfer. It goes in the batches of every 1 hour, half an hour, 2 hour, whatever the batches decided by RBI. So that is the difference between NEFT and RTGS. AUM means assets under management. NEV, net asset value. NPA comes under this after NPA, non-performing assets. MBS, mortgage-backed securities. ABS, asset-backed securities. IFRS, International Financial Reporting Standards. GAAP, Generally Accepted Accounting Principles. IASB, International Accounting Standard Board. YTM, Yield to Maturity. So these are some abbreviation. So this thing is over here. just brief some solvency margin also here. As we have seen in this PPT, solvency margin is calculated available solvency margin divided by required solvency margin. Correct? So
Saurabh,
available solvency. Yes,
Saurabh,
sir.
your PPT is not visible, Saurabh.
Sir, I'm just sharing, sir. 1 second, I have just
Okay.
opened. Actually, that PPT is over. I'm sharing a PDF file now. I'm just
Okay.
sending. 1 second. Sir, is it visible now? Not visible. No?
Yes.
Screen is visible, sir, but you have to zoom in a little. It's too small.
1 second. Fine.
Yeah. Yes, sir.
In a solvency, well, we see the ratio analysis also. ASM divided by RSM, available solvency margin divided by required solvency margin. So we have to just see the calculation of ASM and RSM. Available solvency margin means in a common language we can understand the net worth. How there is some modifications in the calculation of net worth that we will discuss here. ASM is a net worth, and RSM is a specified formula how the RSM is to be calculated. So we'll first discuss the ASM. ASM, as I said, net worth. Net worth means asset minus liabilities. A simple definition: asset minus liabilities. So now, but in assets we have to exclude certain assets. So in assets, suppose we take entire assets, then we have to exclude certain assets. What are the assets? Agents and intermediary balance outstanding premium in India to the extent they are not realizable within a period of 30 days. Premium receivable relating to state government, central government, they are not realizable within a period of 180 days. Agents and intermediaries balance and outstanding premium outside India to the extent they are not realizable. In India and outside India, there are 2 types of limits. So in India, there is 30 days. Outside India, the moment they are not realizable, they has to be disallowed. These things cannot be considered in the assets, has to be reduced from the amount of assets. Sundry debts to the extent not realizable. Advances and receivables of an unrealized character. Furniture and pictures. Dead stock and stationery. Deferred expenses. Debit balance of P&L. Co-insurance balance outstanding for more than 90 days. Balance of, so co-insurance balance is not accepted if it is outstanding for more than 90 days. Very hot topic nowadays. Now come to reinsurance balance. If the reinsurance balance pertains to Indian reinsurance or foreign reinsurance having branch in India, the reinsurance balance pertains to the transaction made with that branch which is situated in India, then it can be taken up to 365 days. All other reinsurers in 180 days. Leasehold improvements, service annualized credit, and any other assets which are considered inadmissible under Section 64B of the Insurance Act 1938. So these are the assets cannot be taken. Other assets has to be taken in the calculation of valuation of assets. Liabilities has to be taken fully. These are the formats to be filled. You can remember the format name. TA means admissible assets. Amount of liabilities. Liability has to be shown in 2 parts: policyholder liabilities, other liabilities. Policyholder liabilities we have discussed many times. Premium deficiency, URR, unearned premium, outstanding claims. These are outstanding claims, has to be shown line of business wise. Outstanding claims will include IBNR. So liability has to be taken in full. Asset has to be taken excluding those unaccepted assets. So this is ASM. Now coming to RSM. Now RSM is calculated in two ways. RSM1, RSM2. RSM1 is based on premium. RSM2 is based on claims. Based on premium, how it is calculated? It has to be calculated line of business wise, like fire, marine, this marine cargo. Gross premium, first we'll take gross premium and net premium. Gross premium means right premium plus RA accepted and net premium. Then what we'll do, we'll calculate factored gross premium. So we'll take gross premium here. There are factors mentioned against each LOB. So we'll multiply the gross premium with factor. So it will be factored gross premium and net premium. So factored, whichever is higher, 20% of factored and factored gross premium, net premium, whichever is higher, will be the RSM1. 20% of factored gross premium or net premium, whichever is higher, will be the RSM1. Then we'll go for gross incurred claim. So this is RSM1, 20% of factored gross premium, or factored gross premium is gross premium divided by multiplied by factor and net premium. In case of RSM2, this 20% will convert to 30%. Same calculation. Gross factored gross incurred claim and net incurred claim. 30% of higher of the gross incurred claim, factored gross incurred claim and net incurred claim will be the RSM2. And higher of this RSM1 and RSM2 will be RSM of particular LOB. This is how RSM is calculated. In case of this gross incurred claim and net incurred claim, see, group premium and net premium will be calculated will be taken from last 12 months, trailing 12 months. In case of incurred claim is to be taken 36 months, trailing 36 months divided by 3. So it will be 12 months, last 36 months. So it will show the trend. This is the calculation of RSM. So again, I'll just again brief this. It has to be calculated RSM1 and RSM2. Higher of the RSM1 or 2 will be RSM. RSM1 is calculated on the basis of premium. RSM2 is calculated on the basis of claim. Premium means gross premium multiplied by factored gross premium and net. We'll compare the factored gross premium and net premium, whichever is high. Of that, 20% of that will be RSM1. And same thing, factored gross incurred claim and net incurred claim, whichever is high, of 30% of that will be RSM2. And higher of the RSM1 or RSM2 will be RSM of the particular LOB. And ASM, so divided by RSM, will be our solvency margin. So, sir, I think this is over from my side. Anyone has any doubt, anything to be asked? Ramesh, sir?
Will there be anything regarding IFRS?
IFRS, as of now, it is not applicable. So it will not be asked because in insurance companies, it has not come. It has been extended. Earlier, it was applicable from 2020, then it was extended. So as of now, IFRS is a broad study, and on the basis of IFRS, our Ind AS has been prepared by the ICI. So, and the numberings are same, like whatever the IFRS numbering is there, 104 is for insurance contract, but it will not be asked in the exam, I don't think, because it is not applicable as of now in India for Indian companies.
Thank
Indian
you.
general insurance companies.
Yeah, Saurabh sir, it was
Yes.
a very good session. Like we have been able to get, we have been able to learn so many useful concepts in accounting. Sir, I just had a doubt. Like you had shown us the balance sheet and everything. So I was just curious to I mean, think that can we have something like bad debt in the balance sheet of a general insurance company? Because like
Definitely.
we generally don't have debtors. Like in case of co-insurance only, there would be debtor. Otherwise, like there is just loan which we offer to our employees only. So can we have bad debts in our balance sheet?
Sir, we do not have bad debts, but we have provision for diminution of assets, provision for bad and doubtful debts. We have
Diminution of
investments.
asset, that thing is there because there would be fluctuation in the value of maybe like shares or like our investment. That would be there. But if we are talking about in crude sense, like proper bad debt, because like I don't know, I was just looking at the balance sheet of somewhere. No, it was a general insurance company only, and there was this provision for bad debt. So like I was not able to grasp it only that why would they put it?
Bad debts maybe they are only in case where there is outstanding premium. When they are issuing this thing policies on on outstanding premiums other than BG, bank guarantee. There can be bad debts. There can be bad debts in case of loans.
That thing is understandable only. But like regarding premium, we had this concept also that 64 VB should be certified. So what I understand from my knowledge that premium should come in advance. So in case of every policy, it happens that premium we would
There
have
are certain policies where, like in engineering policy, where installments are there. So it is not
that
that
thing
each
is
and
there,
every
car
policy
policy
is
is there.
subject to
It's not
64.
engineering policy. Specifically, it's car policy more than 18 months where the project is more than 18 months. So we can have it in like, 2, 3 installment. That thing is there. So, okay. Then I understood. But there could be better. Right.
Any other doubt?
So there is just one more thing. I mean,
Yes, sir.
yeah, this unexpired risk reserve, we got to know that it has to be created because like some part of the policy it would be served in other this next year or maybe like in other different terms. So that's why we keep it. This premium deficiency reserve. I'm just I get to see this thing like premium deficiency reserve somewhere. So is it like mandatory to create or there are?
Yes. No, it is mandatory. It is mandatory to calculate sub-segment wise, but it has to be recognized only if there is a premium deficiency in the entire segment. Suppose you take the marine. So will calculate premium deficiency for marine cargo, marine hull both. But with the total marine there is a premium deficiency, then only it has to be recognized in the books. Otherwise, it has to be shown in the disclosure forming part of accounts.
That is there, but like I want to tie up my question towards like, is there a need of creating premium deficiency only at the occurrence of certain event? Like suppose like I don't know if I read it somewhere that if only if the ICR for a certain segment is more than 100%,
See, the
then
calculation is like this only, no? See, if you understand in this way, so what is premium deficiency? When your outstanding claims is higher than your
higher than
unexpired
the
risk reserve.
reserve. Okay.
So definitely if your ICR is more than 120, 130%, there will be premium deficiency.
So it's like on a theoretical background, like we can only think up to 100% that whatever I'm receiving as a premium, that much I have to pay in the claims. But if it is crossing 100%, then there is a need of this additional reserve. Additional reserve which is like a premium deficiency, right?
Yes.
Something like that. Right. Thank you, sir.
Ramesh sir, I wait for your instruction.
Is that all there is, Saurabh?
Yes, sir.
That is all. You have finished it.
Yes, sir. Yes, sir.
Okay, now do one thing, you share the PowerPoint to me, my employee number is 44051.
Okay, sir.
We will upload it on the site. It was a very short session, but very informative session for people who are interested in accounts. Normally, accounts does not have many takers, but Saurabh was very kind to spare a Saturday and come and teach us. Thank you very much, Saurabh.
Thank you,
For
sir.
all other participants, we will upload the video and PowerPoint that Saurabh will be sending us shortly in our website, uiioa.in. You can go there and download it. Now, from all of you and from behalf of UIOA, I thank Saurabh for having spared this time for us and teach valuable points to our people. Thank you very much, Saurabh.
Thank you, sir. Thank you very much.